All right. Well, it's 12 o'clock noon. We'll go ahead and kick off this month's edition of the Aftermath. Thanks for all those of you that have joined online, here in person as well. So we'll dig it right in and talk about what's going on in the markets, what USDA had to say here in its report an hour ago. And honestly, it wasn't a whole lot. They did make a lot of changes, though. I went through a lot of the numbers, especially the world numbers. They did a lot of tweaking, but most of us were primarily concerned with U.S. stocks as well as South American production. You can see just the quick summary here, and then we'll dig into the crops. But from a summary standpoint, corn ending stocks down 100 million bushels. Soybeans were unchanged. Wheat was up 5 million bushels. In South America, the changes there were in Brazil with the beans. Bean crop went up 2 million tons to 180 million metric tons, and that was kind of in line with what a lot of people were expecting, I think. So with that, we'll dig into each of the crops, and let's start off looking at soybeans. And probably the biggest story of the last 7 days in beans was another comment from President Trump that China could buy another 8 million tons of U.S. soybeans. Got the bean market up and going last week and got us back above $11 once again. And so think a pretty good marketing opportunity there. And so when you look at what it means, this was the chart from No Bull that we'd been sharing for a couple of months now, but I added the 8 million tons here for this year. If it happens, that would take us up to 20 million tons for this marketing year. And you can see that the trend had still been going down, but it gets us back up close to where we probably would have been if China had been buying beans back in September, October, when we were kind of shut down with them. So the trend has been down. We've known that for a long time. Brazil's going to continue to dominate this market, probably going forward as they continue to raise bigger and bigger crops every year. What we're kind of looking forward to with some uncertainty is what happens in the next 3 years. China has agreed, we think, to buy 25 million tons of beans each of the next 3 years. I keep saying if that happens, I think that's a tremendous tremendously positive thing for the bean market because of the trend that we'd been seeing over the last 5 years that exports were continuing to drop going to China. So we'll see if it happens, but if it does, I still think that's a very positive thing for beans. Now, I saw this chart this morning from MD Commodities. You look at the value of U.S. beans versus Brazil and Argentina. You've got U.S. here in red. You got Brazil and Argentina down below. Our beans are a lot more expensive than theirs are right now. So there's no reason based on market price that China would buy beans from the United States today. The only reason they're doing it is because of trade negotiations. And so therefore, you kind of throw common sense out the window a little bit when you're trying to figure out what's going to happen because there's no reason for them to do it. That said, if we force their hand because of trade negotiations with something else, then that kind of is what it is. So I'm kind of curious to see what what it is that we're going to do for them if they're going to buy our 8 million tons of U.S. beans this year. So we'll see what happens. Now, looking at the balance sheet today, 0 changes from USDA. The blue column, second from the right, that's this year's numbers. The government kept everything alone, so they did not factor in any additional exports to China yet. I guess they're going to maybe be a wait and see if it really happens. But as of right now, they're still forecasting exports down about 300 million from last year. Crush demand still very strong. Ending stocks still at 350 million bushels, which is the highest we've been in about 5 years. So by itself, the fundamentals, the balance sheet numbers aren't real bullish to beans for any reason. So we'll see if it really does happen or not with these extra sales. Looking ahead to next year, just while we got it on the screen, these are USDA's baseline numbers for 2026-27. They were forecasting a jump in acres this coming year and probably an increase in ending stocks at the end of next year. So we'll talk more about that here after a bit. As far as this year goes, though, because we're behind in making the sales, you can see that we're behind in shipments. It's been a really lousy start to the marketing year as far as export loadings. We anticipate probably seeing this green line, though, kind of extend sideways out here in March, April, May, because we do have boats to get loaded going to China. So probably counter seasonally a little bit high this spring, more so than we would typically do because of the lateness of making these sales this year. And you can see year-to-date shipments for the first 23 weeks of the marketing year, the lowest we've been in quite some time. So it's been a negative. We'll see if it eventually turns positive. Now, the big positive for beans has been the crush. Domestic crush numbers continue to set new records. We anticipate this happening on into 2026, maybe on into 27 as we get new plants coming online. So we're making up a little bit for what we've lost in export demand, maybe not quite enough for what we've lost this year. So this morning we did get the updated production numbers for South America, and I updated this chart showing Brazil in green at 180 million tons. That would be a record. They left Argentina unchanged at 48.5 in blue. The U.S. crop this year at just under 116 million metric tons. So all three combined would be a record production this year. So we're going to need that extra Chinese demand, it looks like, if we're going to chew through some of this extra production that we've had globally. So what's going on in Brazil right now? They're harvesting beans. Harvest is just really cranking up. Overall, they're about 16.5% complete. The state of Mato Grosso here in green is pushing 40% complete. They are planting corn right behind the bean combines right now. So pretty important time weather-wise down in that part of the country to get the crop out of the ground and get the corn planted. And then they want to get more rain again. As you look at their forecast, it's been kind of hit and miss. This was a map from a couple of days or so ago that was showing Brazil expected to get pretty good rain. I think they've gotten that rain. As I looked at a new map, I haven't updated it yet, but looks like they're going to dry out a little bit here in the days ahead. So should be pretty good for harvest in that part of the country. Down into Argentina, they had some rains expected, which were very, very much needed. And so there have been some talk about shaving the crops in Argentina. USDA did not do that here this morning. So we'll see what their weather looks like as we go forward. I saw this map that Karen Braun shared the other day. I thought it was pretty interesting. This is the state of Mato Grosso overlaid across the U.S. Corn Belt. Shows you how big that area really is in central Brazil. So basically covers, probably 3 or 4 of our biggest states if you looked at the Corn Belt. So it's a pretty important time down there for the harvest, and looks like things are off to a pretty good start. Here's a snapshot of where the funds were at as of last Friday. They're currently long about 29,000 contracts of soybeans. You can kind of see what they've done the last several months, though, since the beginning of the marketing year. They went into October basically even. And then when the China news came, the funds went on a huge buying spree, went to the highest long position they had since back in, I believe, 2020. It doesn't show up on the chart here, but they were holding a similar long position in 2020. And then just as quickly, they unloaded all of that long position that they had just bought. I think because of the slowness of getting the actual sales made, the funds decided they didn't like being that long, and so they liquidated most of it. And now they've started building some length again with some of the renewed hope of more export business. But it really just spills into this March chart. It really mimics, it mimics what they had done in what the funds had done. Went on a big buying run October, November, turned around and sold it all back, took us right back down to this trend line once again. And now here you can see last week when that China news got announced, or when President Trump's tweet came out, you could see the big rally we had, and then we extended on up after that, going into the end of the week. Here this morning, market was up a dime just a minute ago when I updated the chart, so we're back to 1120. I've got the RSI showing down at the bottom at 69, stochastics up in the 70s, which I would say is a sign to reward the market. If you haven't yet, I think it's a good place to be locking in some old crop beans, maybe even getting rid of the rest of them if you don't want to hold on. And, we are moving into that window of South American harvest. I showed you earlier that U.S. beans, especially with this rally, we're priced well above Brazilian soybeans in the world market right now. So, other than maybe some forced demand from China, we shouldn't be selling beans to anybody else around the globe right now. Everybody ought to be buying their beans out of Brazil if the logistics help out, if as long as they can get the bean boats loaded. Saw a story yesterday that talked about the United States importing beans out of Brazil. Wouldn't be a shock to me if see that happen this summer, that we bring beans into the southeast coast. We do that a lot. It seems like with the valuations the way they are right now, it's cheaper for the Carolinas to bring beans in out of Brazil on a boat than it is to bring them by rail out of the Midwest. So that's probably going to happen, especially if the spreads stay like they are. Looking ahead to new crop, we are a few days into the pricing window for most of our states. Southern states are just a couple of days away from being done pricing for crop insurance. That average price in the north right now running 1088, which is up from 1054 last year. Up a little bit from where the margin price was back in the fall. So we'll see where it goes for the next 3 weeks. We did trade back up above $11 this morning. I've been suggesting for a few months now that hedging beans above 11 seems like a good idea to me. With more U.S. acres expected this spring, with a record Brazilian crop getting harvested right now, and with uncertainty over China, I think it's a good place to be hedging some beans, at least getting something locked in here for this coming year. So also, if you look at the bottom, stochastics are moving up into the 80s now. Getting a little bit toppy, I think, at least on a short-term basis. So not a bad place to be locking something in. Switching over to corn, this morning's report, we had one change in the balance sheet, and that was in exports. The government raised that number to a new record, 3.3 billion bushels. That's up 100 million from last month. So that continues to be the bright shining star in the ag demand side of things. This year has been exports. Ending stocks dropped 100 million down to 2.127 billion. So still a bearish carryout number, but not as negative as it has been. Total demand at almost 16.5 billion. That's a record. So we're doing all we can to chew through this big crop this year, but 17 billion bushels of corn is just a lot to get through. And so we're doing our best at the moment. As far as next year, the government back in December told us they think we'll raise less corn acres in 2026. We'll see if that happens. I'm hearing some resistance to that. So I don't think the I states, the Midwest part of the Corn Belt, will probably shift a whole lot. I do think we're going to see some shifting maybe around the fringe of the Corn Belt. So we'll see what happens there. Demand, the government is starting out forecasting a big demand number for this coming year. They're still forecasting ending stocks a year down the road above 2 billion bushels. But this year, the export number I mentioned just a second ago, easily a new record high. Last year was a record. So that's the quiet positive in all of this, is that we're building a good demand base. Ethanol right now is at a record high. The feed demand that the government's using is a record. I still not sure I believe it, but they're still using a record number there. So if somebody has a problem, with production somewhere around the globe, we're building a heck of a base on corn demand. And so that's a pretty positive thing, I think, for us as we go forward. Exports, maybe partially due to the lack of bean loadings this fall. We were making records every week as far as the loadings this year. Now, we're kind of come back to earth a little bit now that bean loadings have picked up. And, keep in mind, we've got limited capacity, so you can only load so many boats at a time. Wheat loadings last week were big, so corn still kind of hanging in a seasonal pattern right here. And I would expect that with the big export numbers forecasted that corn loadings are going to stay strong on out into spring and summer. But you look at our year-to-date numbers, a record high. So it's been a heck of a year. Basis levels on the river system probably reflect this, that we've had good corn loadings and that the market needs to continue to compete for corn going to the Gulf as well as the Northwest coast. I've been suggesting for a few months now that if you want to be bullish corn, one reason is the world numbers. And if you look at U.S. numbers in red here, stocks to usage, not so bullish, but the world 19.2% is the lowest we've been since 2013. So, I'm not saying we're setting ourselves up for a rally, but if somebody, one of the big producers, has an issue, certainly Brazil, probably the big one right now because of how much corn they're using domestically for ethanol. They're really cranking up the ethanol program in that country, and that takes them away from being an exporter. There's been some people wondering, because we've had some sales coming out of the United States that were marked to unknown destinations. Some folks are wondering if that would be China. And I don't know if they are or not. I haven't really heard any rumblings that would suggest that it is, but sometimes South Korea buys their stuff as, optional origin or unknown destinations. So, but certainly, something that would happen around the globe might be the reason we would get a rally in corn this year. As we sit here today, funds are short about 69,000 contracts of corn. They had gotten back to even here this winter prior to the January crop report. Then when that big crop came out in January, the funds went back to the sales side again. I kind of believe that, though, that this is a potential positive, the fact that the funds are short the corn market. If there's any reason given for them to buy it back, I think that this market could get a little boost. And seasonally, we tend to do that as we go into spring. So I'm not real negative from where prices are at today in corn. Tend to think we've got some potential. If you look at the chart, I didn't go all the way back to spring, but you go back to this last year, there was really no reason for the funds to want to be long the market. We were planted big acres in the spring. We had a good crop going. We eventually made our low in the middle of August for the second straight year. The market did bounce back through harvest. Part of that was driven by the funds buying everything when the China negotiations were taking place. Part of that was driven, I think, because of lack of corn carryover from last year and the fact we had a lot of open bin space going into fall. We were pretty much a sideways pattern November, December, January going into the report. We had the big down day following USDA's surprise on January 12th, but things have kind of come back a little bit again. Here this morning, we were pretty quiet, up a half cent. The indicators at the bottom of the chart, all pretty neutral right now. Going into the crop report, we were basically in a 435 to 450 kind of a window. Now that the report's behind us, I think that, we've kind of dropped down 15 cents. That triple bottom has now become upside resistance for the market. We've tried to push back up there a couple of times at the end of the week last week, and we're really not able to get through that 435 area. So as you look at this chart, 435 to 440, not only do you have this triple bottom where this orange line is, but you got all these moving averages, the 50, the 100, the 200-day moving average, all in that 435 to 440 area. So you've got a lot of uphill resistance here to get the market to really move much. If you break through that, though, then you're probably another dime up to 4.5, and who knows if there's something behind it, like Chinese demand, maybe you make a run at 460 or something. So I would say, this 435 to 440 area, if you've got to sell corn in the next 30 days, probably going to be your best bet. If you want to put some offers in up at 4.5 or close to it, probably not a bad place to be maybe looking at selling some corn out in the spring. The other thing to look at, from a basis standpoint, I would tend to think spring is going to be our best bet. Go out into the planting window, April, May, and I realize nobody wants to haul corn and plant at the same time, but that's probably going to be your best bet from a basis standpoint. I'm concerned of what could happen to old crop basis getting into summer, kind of like happened 2 years ago. If our carryout's really above 2 billion bushels of corn, and we don't get a rally in the board between now and then, I would tend to think that July, August, you're going to see a lot of corn wanting to move to market once again this summer. So just, beware if you're planning on holding corn into summer that, don't be the last person holding corn when the music stops, because there's going to be a lot of people probably trying to clean bins out this summer once again. So, between now and May, I would tend to think it's probably going to be your best window to look to make some sales. Looking ahead to December, pretty good carry in the market still. You're 429 to 458, so a 29-30 cent carry from March out to new crop. I'm not really wanting to be a seller right now in December corn. I've said that for a few months now, because I don't think we're looking at very profitable levels here around 460. We're setting our insurance price right now. We're averaging about 457, 458. The indicators at the bottom of the chart pretty neutral right now. So we have gotten up off the floor after the big sell-off after the January crop report. And now we'll just see where we go. We've got a lot of uphill resistance, this 457, 458, 460 area. It'd be nice if we could get consecutive closes above 460, might open the door for some potential upside. I'm still in the camp of thinking 480 to $5 is probably where I want to put some offers in. I probably don't want to get too excited at the current levels, and we'll talk about some reasons how we can protect price here, or why we don't want to be a seller here in a few minutes. Wheat, not a big change today. The United States, or USDA, lowered the food number 5 million bushels, raised ending stocks 5 million bushels. That was it. 931 million. That was a big carryout number. So despite the fact that exports are big, we just had a big crop to work through this year. Consequently, ending stocks are up. Next year, they're forecasting a little less acreage, a little lower ending stock number out into 2027. The quiet positive in wheat, though, has been export loadings, and kind of like corn. We've been able to ship a lot of wheat this year, even though the bottom line and the balance sheet is still big. Export loadings has still been pretty good. So the best we've been since got it all the way back to 2016-17, the last time we'd loaded this many bushels of wheat through 36 weeks of the marketing year. So that's quiet positive. The world numbers, are kind of starting to work back up for the first time after, about 6 years of downward movement in the stocks to usage ratio. So not a real friendly thing here for wheat either. And the U.S. numbers, of course, pretty bearish here with the growth in our stocks here recently. So weather-wise, is there anything here to hang our hat on in wheat? If you look at the drought monitor, really for the plains, it's one of the better years we've had at this point in time. Winter wheat in drought, though, has come up a little bit, up to 43% of the winter wheat producing areas. There is, would be some concern certainly down into Oklahoma, Texas especially, but Kansas, western Kansas looks pretty good right now, eastern Colorado. So maybe there's something to get a little excited about as we get into spring. We'll watch the weather forecasts as we go forward. But the funds, big time short in Chicago wheat right now, 82,000 contracts. They bought a little bit of it back here in January, but still historically on the, big time short position. Been short they have this whole marketing year so far, going all the way back to June 1. They've been on the short side of the market, and you can see the impact. July wheat actually made a double bottom here, December, early January. We up off the low about 35 cents or so, and now we back down, sitting within this cluster of moving average lines and really no direction. You look at the RSI at 51, stochastic's pretty neutral right now, so just no real direction whatsoever. Been looking at the 200-day moving average, this blue line, for many months now as a target. You go back to the fall, that was above $6. Now it's all the way down to 572. So the more days we trade below that, the more we keep that line working lower. So that would be a good target if you want to make new crop sales. Also, if you look at the crop insurance price last year, we're at 563. I always try to market above that price if I can. So probably want to have some offers working up around 570. Maybe not a bad place to be looking at making a hedge. Kansas City wheat, pretty similar looking chart, although they're not holding as big of a short position. Funds are short about 9,000 contracts. They've bought back a bunch of that KC wheat, and maybe that's a little bit related to weather. But price-wise, still pretty similar to Chicago wheat right now. Still sitting around 550 or so. And again, the 200-day moving average at 571, probably a pretty good target if you're looking to make some sales. Minneapolis wheat, funds are short about 20,000 contracts here. Still historically a pretty short position, and this market just continues to hang near its contract lows. So nothing to get too excited about here from a marketing perspective as well. And then finally, cotton. We did see a negative change in the cotton balance sheet today. United States or USDA lowered its export number. I don't think that's a big surprise. I think everybody's been thinking that the cotton export number was too high, probably still is too high, but that took ending stocks up to 4.4 million bales, took the average farm price down a penny to 60 cents. Where this comes into play, I know we got a lot of people on the call, and where I'm at in person thinking about, or not really thinking about cotton, but where this can come into play is the acreage in the Mid-South and the Southeast this year. And will we plant 9.75 million acres to cotton like the government says? I don't see a reason why we would increase cotton acres this year. I know we were historically low in 2025. I'm not so sure that number can't get smaller here even in 2026. So what are we going to plant instead? I don't know. Beans, probably soybeans would be the most likely crop. But if you look at the balance sheet from USDA, they still think we're going to increase ending stocks again a year down the road in cotton. So the funds, historically short for this time of the year, short about 72,000 contracts. We're giving them no reason to buy it back. The Chinese demand has just not surfaced this year at all. And I think the funds are just kind of in a wait and see mode. They've been short. Shoot, you look at the red line, they were short all of the 24-25 year. They've been short since, you got to go back into 23-24, the last time they held a long position in cotton. So they've been right. The short has been the way to go. And you look at the chart, goodness, it's just been in a straight downward slope since clear back in 2024. Made a new low last week at 60.9 cents. We pushed back this morning, tried to hit the 9-day moving average. We're not able to break back above it. So to get serious about this market, you probably got to at least get to the 100-day moving average, which is now below 65 cents. So not a good sign. The only thing I can say good is if you look at the bottom, the RSI has turned higher. Stochastics did cross higher yesterday, so we'll see if we can get some momentum to change this thing to the upside. Looking at 26. Right now, our crop insurance average is down a penny from last year at 68 cents. We're struggling here. Again, nothing to really get too excited about at the moment. Can you get back above this cluster of moving averages? Get back to 69, 70 cents. I think it's 70. I'd probably want to start looking at maybe laying off a hedge or so, just to get something on the books in case we continue to flounder down in the low 60s a year down the road. So looking at a few other markets, and before I do that, I guess just an overall picture of the fund position in the ag sector. Right now, went long briefly this fall with the buying in the soybean pits, and since then we've been back on the short side again. Although the last 7 days or so, funds have been buyers. Some of that in beans, some of it in meal. This is just grains and oil seeds, so they've covered a little bit of their short in corn, a little bit of their short in Chicago wheat. But generally speaking, the funds see no real reason they want to get on the long side of the market right now. Looking at the latest market report email, just a quick mention of the heat check column on the left-hand side where we try to identify the hot and the not markets. Did have soybeans in there yesterday. We had soybean oil. We had cotton in the not zone. But soybean oil, I did want to mention, it did make a contract high yesterday and again this morning. So quietly, the bean oil market has given a boost to, I think, oil seeds in general. And the biggest reason here was a week ago that was announced a trade deal with India. And India is thought to be a pretty large buyer now of U.S. bean oil this year. So we know that we're raising, that our domestic crush is growing. And a big reason for that is the oil production domestically. Well, now you've got some competition from India and some of these other Southeastern Asia countries as well. But bean oil, if you look at the indicators, the RSI at 74, stochastics in the 80s, 90s, probably worth probably at a point where we need to sell this market if you're trading bean oil, but nonetheless, pretty good bounce here. Feeder cattle. I've had this market in a hot zone for a little while. It's kind of gone into a sideways pattern, it looks like. We bumped up against this little chart gap that we left back in October when the market liquidated the first time. So probably not a bad place if you use the insurance program, the LRP, livestock risk protection. Probably not a bad place to essentially buy a put with that. We are $9 off the high here in March feeders, and RSI and stochastics have turned kind of south here lately as well. Gold and precious metals, silver, copper, everything made highs here a week or so ago. We did sell off pretty majorly. You look at the RSI here in the gold, the RSI had gotten up to like 95 or 96, just remarkably high. And then we did liquidate again, and now here we are seeing some more buying again. Now today the market's down a little bit, but all these markets have kind of gotten back up and going again. The 20-day moving average, the blue line, has kind of continued to trend higher. So that's given us a little bit of a lift. So something to keep an eye on. And if you look at the Goldman Sachs index, and I mentioned this last month, and I mentioned it in my market report email as well, but the old saying that a rising tide lifts all boats, I think you've seen a little bit of that happen with some of these markets. I think when the precious metals markets have rallied, the energy markets, we had a huge rally in natural gas back in January when we hit that cold snap across the country. That kind of backed off a little bit. Crude oil has gotten back up $63, $64 a barrel. And you can see that the index with the rally in livestock as well, you've got commodities trading really at the highest level as a basket since back in 2024, the early part of the year. So can that continue? And if it does, will it help pull corn, soybeans, wheat, cotton along with it? Typically that's the case. And so if you want to root for rallies in the ag markets, certainly rallies in oil, those things would tend to help things a little bit as well. So one look ahead to the growing season. We've started already to look at maps. There's a forecast of a shift here in maybe to a El Nino pattern by this spring. What does that typically mean? Well, El Nino typically means pretty good crops and pretty good moisture around the central part of the country. And so if we look at the European model forecast for March, April, May on the left, June, July, August on the right. Now this may not be great for the planting window, but you see going into spring and summer, most of the forecasts, pretty wet throughout the center part of the country. So typically in an El Nino year, we typically make pretty good crops across the country. So I know it's way too early. We can't forecast next week that well, let alone trying to forecast summer. But based on some of the changes here, things look fairly enticing for much of the country. We'll see what that means for 27 later, but normally then you start to see that. You see this little dry spot down in Arizona. Normally when things eventually shift, then the following year you might see that dry spot start to move across the country. So too early to talk about 27 yet. But I do want to shift pattern now to government programs. We've talked about these every month. We'll continue to update these because I really think that, there's so much going on right now with the farm programs, and a lot of it, quite frankly, is going to be very important to us. I don't want to get into the discussion about the payment programs. We've talked about that a lot. SDRP sign up for phase 2 is going on right now. The Bridge Assistance Program, those applications for that money should be sent out the third week of February. So here in a week or so, you should be getting an application in the mail. That's coming from DC. That's going to have your acres that you certified last year. And when you send that back here about the beginning of March, you should be getting some money in the mail or auto deposited to your account. But the numbers that we had seen posted, $44 an acre for corn, I think around $30 an acre for soybeans, cotton's over 100. So those numbers will be, that money should be paid here after the first of the month. But again, I do want to focus on the one big beautiful bill because that impacts all of us and some of the decisions that we have to make this year. The highlights, and I've showed this chart for a few months now, but we did see an increase in the PLC program. We've seen an improvement in the ARC program. For 2025, just another mention to this because I keep getting asked all the time, but producers are going to get the higher of a PLC payment or an ARC County payment for the 25 crop year. That payment won't be made until the fall of 26 because we'll have to wait till the end of the marketing year, which is August 31st, to determine the final market year average price. So don't go spending any money just yet. But I know we went and signed up for one of these programs last spring. That doesn't matter what you signed up for because since the big beautiful bill was passed after that, they're going to give you the higher of either or payment. Starting in 26, we will again have to pick a program. We don't even know when that sign up's going to be, and I'll talk about that here in a minute. We're going to see up to 30 million base acres added. So a lot of ground that's been broken over the last many years. Some of those acres are going to get some additional base, and that's a big deal because these farm programs pay on a percentage of base acres, not on what you plant. We're going to see an increase in the per entity payment limit of $30,000 up to $155,000 per entity. Beginning farmers and ranchers, if you farm less than 10 years, you're going to get some additional discounts on your crop insurance. That was expanded from 5 years. The county insurance programs that stack above your individual coverage, SCO, ECO, and MCO, those subsidy rates went to 80% going forward. That's huge. 2 years ago, ECO is at 44%. So we've almost doubled the subsidy now. And the government's really trying to make it advantageous to purchase those programs. Also, crop insurance and FSA programs have been separated going forward. So in the past, you had to make some choices. Now going forward, you can do whatever you want on crop insurance. It has no impact on what you do at the FSA office. So these are the updated prices after today's report. The market year average prices in the gray box with the blue line around it. The only crop that we saw a change in, I think seed cotton's probably going to go down a little bit. We haven't got that number yet, but sorghum went down a dime to 360. Everything else stayed the same. Corn still 410, beans 1020, wheat at 490. Why is it important? Well, when you look at the numbers, and I've talked about this for a few months now as well, but the light blue box or the dark blue, whichever one's highest, those will be the PLC reference price you get to use for the 25 crop year. So for crops like corn, soybeans, sorghum, that number is 88% of the ARC benchmark. So you get the higher of that or the statutory reference price here in the dark blue box. And you take that number, subtract the market year average price in the gray over here to determine the amount of a PLC payment. And as of right now, corn still would be 32 cents a bushel. Soybeans would be 51 cents a bushel. Wheat would be what, $1.45 a bushel. And those payments don't come until, like I said, next fall, after the final price is established on the 31st of August. But as of right now, we're looking at some substantial payments. Every crop right now would be eligible for a PLC payment. So as of today, we'll continue to update these every month as we go forward and get the new USDA report. But right now we're looking at money. Now, ARC could also pay in some areas because these are going to be the ARC price. We're going to take the ARC revenue price here at the benchmark times 90% gives you the bright red box times your county's 5-year Olympic average yield. That determines your ARC trigger. Then at the end of the year, we take the final county yield times this price in the gray over here. And if there's a revenue loss, you'd get a payment on ARC as well. What I would gather in corn and soybeans in particular, if your county probably had a pretty good crop this year, ARC's probably not going to pay you as much as PLC would. If your county did not have a very good year, then ARC County might be the one that pays the most. So I've done some math. If you go across the center of the Corn Belt, for the most part, I think PLC program's probably going to be the one that pays the most. If you get in places like Southern Illinois to Kentucky, Tennessee, for example, on corn, where your corn yields maybe weren't as good, then that area, ARC County, might be the one that pays the most. But you're not going to have to make that decision because the government's going to pay you whichever one is the most. So we'll just continue to monitor this throughout the year. I've had several lenders inquiring, what do you think the ARC payment or the PLC payment's going to be? Well, don't count on it just yet because, the marketing year's got a ways to go. We're still, 6 months, I guess, from the end of the marketing year. Looking at 2026, we are going to have to make a decision between these two programs, but the Deputy Ag Secretary made a statement last month to a group and said that producers will likely know their yields and production before they have to make this decision. He basically indicated that it's going to be later in the year before you have to make this program election. So if you get to know what your crop size is going to be before you have to make a choice, then you're going to be able to determine, well, is ARC make the most sense if we think we had a crop loss? If not, then if the price is going down, then maybe PLC makes the most sense. The prices we're going to use are all going to stay the same one more year. So these ARC benchmark prices, the PLC's effective reference price, all these numbers are going to stay the same for the 26-27 year. The price estimates early from USDA over here in gray, these are their baseline numbers that they put out back in December. And as of today, every one of those would be low enough to trigger a payment on PLC for next year. So kind of the way I look at this, with the markets where they're at today, and if you look at, you go back and look at the charts, but where the markets are today, there's not a lot of reason to jump out and forward sell some of these crops. If you look at corn today, for example, corn right now on the Board of Trade this morning, about 458. If you figure a national average basis on corn of about 20 under, it's about 438 be the cash price in the country today. And 438 sits below this effective reference price. So to me, at 458 December futures, I don't have any incentive to go forward sell corn. I've got protection, essentially a put option right now that the government gives me the option to sign up for. Couple of other things. ARC has a 90% trigger. It's going to use these numbers in the bright red box. ARC has a 12% band, a maximum amount that it will pay. So that roughly, let's say it's $100 an acre is the most you might be able to collect from the ARC program. PLC does not have a limit. We saw an article last month, and I sent it out with my market report, but one guy that wrote this article suggested that in a very bearish situation that corn price could go 330 to 370 next year, which makes you choke. But if you think that can happen, then you would want to sign up for the PLC program because PLC has no downside limit. PLC is going to protect you as far down as the market year average runs. And if we end up, say, 350 corn next year for some silly reason, let's say we plant 100 million acres of corn, we have a 180 something yield, and carry out goes to 3 billion bushels, and we go to $3 and something corn, PLC is going to give you a price floor, down to that level. So if you had to ask me today which one I would sign up for, it's probably a coin toss. If you're really, really bearish or at least want to protect no matter what happens, PLC is a way to do it. If you go with the USDA numbers and you say we're going to start at, we got a reference price on corn at 410, you got an ARC price at 503, and if the county yield didn't change next year, actually ARC would pay you more money if we go to 410. So we've got this calculator built. We can run your numbers in it. You can, say, well, what if this happens? Then you can make a determination. One thing about the program, you can sign up farm by farm. If a guy said, I just don't know which one to pick, you could put half your farms in ARC, you could put half of them in PLC. Then you got a revenue floor here, you got a price floor here. You've got different ways to go about it. You can do it different by crop, you can do it different by farm. So it's way early. We don't have to make this decision for a while. We won't even, they haven't announced when. We'll dig into this a little further as we go into spring and summer, but just want to continue to keep this out there in front of you. Also, you're probably going to hear, I know the House of Representatives has talked about wanting to pass a farm bill sometime this late winter or spring. They've got a lot on their plate at the moment, so Farm Bill hasn't been one of them, but Farm Bureau did share this chart the other day. This is what the current discussion of a new Farm Bill would mean for financial outlays, $1.4 trillion. If there's only anything positive for ag here, it is that the percentage in ag actually went up this time from what it's been. For the last several farm bills, the SNAP part of this has been going up. And I think the last time SNAP was like 75 or 76%. So because of the one big beautiful bill addressing Title I, which is the farm programs at FSA, Title 11 is crop insurance, but because they added dollars to both of those titles, then the pieces of the pie over here got a little bit bigger this time around. Crop insurance, I think, went from 9 to 11%. The PLC and ARC parts of this went up as well from what they used to be. So kind of interesting, but we'll see what happens. Now, the reason they need a new farm bill is because the old one has expired. We have addressed Title I and Title 11 in the big beautiful bill, but all of the other titles, conservation reserve, stewardship programs, et cetera, you can see a lot of small pieces in here. All these other little pieces haven't been addressed in the current farm bill. So that's why we need a farm bill, essentially, not only to put this other stuff into law, but also to do the other pieces. Finally, crop insurance, as we look into this year, right now in the southern states, we are 4 days away from finalizing our price averages. You can see where the numbers are here at the bottom of the table, also compared to where they were last year. The corn and the sorghum prices are down a little bit. Cotton's the same. Rice is down. Peanuts are about the same. Soybeans are the one crop that's higher. One thing you'll notice on here, these volatility factors, these are historically low numbers. If you look at the northern states right now, we're 6 days into the pricing window. Corn's down about 13 cents. Soybeans are up 34 cents. Canola bean oil, the oil seeds are higher than they were last year. Wheat's down. So kind of a mixed bag, but the volatility numbers are either tied or about the lowest they've ever been as well. And what that volatility means is the lower the volatility, the lower the premium. And so it's kind of like driving, your kid driving a car, the more volatile the driver, the higher the premium. Well, the less volatile the driver, the lower the premium. And this year we've got very quiet markets, very low markets. And so those are the years we see lower volatility. So that's going to lower the premiums just a little bit, but we've still got 3 weeks to go to finalize these numbers. Um, this is the analogy that I've been showing this winter, and I'll just talk about it once again here this morning. Because of the added subsidies, and because that crop insurance is no longer tied to what you do at FSA, it's a pretty cut and dry set of decisions now. And so I compare the crop insurance decision to basically like going to the restaurant and ordering food. And so your meat of your policy, where you need to start your decision making, is with revenue protection. How much protection do I need on my farm? That's the meat of the policy. Do I need an 85% policy? The subsidy rate went up 3% this year, up to 56%. Can I get by with 80%? That subsidy rate went up 3%. Anything below 75 and down, the subsidy rate went up 5%. So what level of protection do I need on my farm? That's the number one decision to make. Number two, then, is do I add SCO? Supplemental coverage, I'm comparing that to my side dish. That's my extra filler. That's how I get full. One thing about SCO, they bumped the subsidy rate to 80%. SCO starts where your individual coverage leaves off and covers that middle band up to 86%. You don't have to buy SCO. You can, though, if you want to add that middle layer of coverage. A lot of people this past year didn't buy SCO because the ARC County program essentially was kind of mimicked that. But you could only do ARC or SCO. This year you can do both. Or I could sign up for PLC on my farm program and utilize SCO to cover a middle band of revenue protection, utilizing the price here in the month of February. The next band above that is ECO. We had a big jump in ECO policies written the last 2 years. This year, I think that's going to jump even more because they bumped the subsidy rate to 80%. 2 years ago, it was 44%. And so now the government, and we can look at quotes, but if you look at a whole package of RP, SCO, and ECO, the cost is down about 40% or so from what it was last year. I compare ECO to kind of like getting your dessert. That gets your dollars as high as you can on a trigger up to 95%. And at the 95% level, it just doesn't take a whole lot to trigger a loss. I think we're going to see ECO pay out a lot this past year on corn. We're still going to wait until we get the final county yields, but the price went down a little over 10% this past year. So because of the drop in the price alone, that's more than the 95% trigger. So if your county yields were not exceptional this year, then ECO is probably going to pay some money back. And that's kind of how I look at it this year. From a price perspective, if you think price can drop again 5% or more, then ECO is probably going to be a good way to protect that price. And so here's an example today. I just did a random set of numbers, just said we got a county of corn in the Midwest. If we start at a $4.57 base price, and let's say that the harvest price this fall goes to $4.10, that's what the government's projecting for an average farm price for the entire year. But let's say we go to $4.10 a bushel. My APH, I do get credit on ECO and SCO for how good my APH is. And if my APH is higher than the expected county yield, I'm going to get a few more dollars of coverage essentially from ECO and SCO for how high my APH is. So if my APH was 210, then I take that times the higher of these two prices, comes up with my crop value, multiply that by my dollars or percentage of county level coverage. And in this example, I said that I bought an 80% RP policy, and then I used SCO and ECO to cover from 80 to 95%. So I got a 15% band of county coverage at the top, which that band is worth then about $144 per acre. Let's say this year the county yield, we're expecting it to be 200 bushels. It comes in at 200 bushels. But because of the drop in price of 47 cents, we end up making our revenue ends up being a 10% drop, a 10.3% drop, which 87 or 89.7% is below my 95% trigger up here at the top. So that's a 5.3% revenue loss below my trigger. 5.3% of my 15% band, it's about a little over a third of that band that I get to collect, which that band was worth $144. I collect $50 an acre. just because the price went down. No change in the county yield. So if you think that that can happen this year, if you think we're going to plant enough corn acres to where it's going to be, hard to get the market to rally. And if I don't want to go sell corn today at 457, then one of the best ways I can protect price right now is essentially with this 80% subsidized put option that the government's given us. Also, we can look at the matrix below here in the printout. It's going to show you the matrix here with county yields across the top, with individual or with prices on the left-hand side. And so I can say, well, if corn goes to $4 in the fall and we have a 200 bushel county average, I'm going to get $71.98 back. If we have a yield loss and the price goes up, then you go back to this worksheet. If the harvest price goes up, then my dollars of coverage go up. And so that's how these dollars, the higher the price goes in a yield loss situation, my coverage goes up as well. So if you had another 2012, let's say corn goes to 140 bushel in the county, corn price goes to $6, now my payment goes to $190. One thing I mentioned to somebody when I was walking through this the other day, if you buy 80% or 85% RP, in this example here, the price did not go down low enough to trigger even a loss at 85% RP. So that's important to know because, if the price of corn goes to 410 this fall, and I paid a lot of money for an 85% RP policy, I'm not getting any protection back from that policy. And so the only way we can do that right now is to get these higher coverages, and the government's helping us out this year because of the added subsidy rates. And I can go back historically in our quoter. We can go back in this example, I went back 20 years and saw in a particular county where SCO and ECO would have paid. And so surprisingly, well, maybe not surprisingly, but ECO paid in several counties. I think this is Menard County, Illinois, that I was looking at yesterday with someone. But you can see several times where ECO would have triggered, but even SCO would have triggered, 6 times in the last 20 years. We dipped down with big enough losses, either because of a drop in the price or a drop in yields, or a combination of the two. So I would encourage you to check these out. You got another 30 days in the north. You got another, not that long, about 2 weeks in the south. So just a few weeks left to look at these. So finally, kind of to wrap this all discussion up a little bit, how does this all work together? Because that's kind of what my job is, to try to help people figure out how these things work together. We talked to you about PLC and how at 442, 1071 on beans, essentially you got a price floor for the entire marketing year next year. Well, with SCO and ECO, you've also got some downside price protection as well. So here's what I kind of think going into the year. Decide what level of RP coverage makes the most sense. Again, it goes back to that menu. That was the meat of your coverage. What level of RP coverage makes the most sense? How do I tend to fare relative to the county? Am I always better than the county? Can I get by with less revenue protection insurance? Maybe add the county at the top because it's subsidized more highly? Or do I need more dollars of individual coverage? Next, consider the SCO. That's going to start where your protection leaves off and go up to 86%. Then is the ECO. That's that top 9% band from 86 to 95. And if I look at a price on that right now, that 9%, 86% of 457 corn, that's all the way down to 393. So if a county yield were essentially unchanged, we'd have to go all the way to 393 before you would even maximize ECO. But it would start at 434 essentially with where the prices are sitting today, if you assume a flat county yield. One last thing, consider an option spread. I have to give some credit to Gary from Missouri. He and I went back and forth yesterday on this. He was asking me about beans. I got to looking at this on corn as well, because if ECO even doesn't really trigger any kind of a payment until you get down into the low 430s, then what happens to price between now and then? Do I want to consider protecting that band where we're at today? Well, I went and looked at this option spread. It's a 3-way option spread. Essentially buying a $4.60 put option. It's about where the market's at right now. It would cost you 30 cents to buy that as outright. That's a lot of money. And I don't think most of us would want to spend 30 cents to buy a floor at 460. Essentially, net, that would give you a floor at $4.30. However, if I know that below 430 something, around that level, my ECO is going to protect me, then maybe I sell a 430 put and collect 15 cents a bushel. And to cheapen this up even more, I'm going to go sell a $5 call option at 15 cents a bushel. These are all real numbers this morning. What does that mean if I do all of this? Well, the net cost of this trade is zero because I pay 30 cents for the put, I collect 15 for the put I'm selling, and I collect 15 for the call that I'm buying. If we trade below 430, what happens then? Well, my 430 put is going to lose money, but my 460 put is still making money. So essentially, they offset each other. If corn goes to 420, my 430 put that I sold loses a dime, but this one makes 40 cents. So net, I made 30 cents. I made that 30 cents I was protecting at the top. Plus, I have ECO that's probably going to start to kick in below 430. Plus, I have a PLC program at the FSA office. So if corn goes below 430, I've got at least two other ways that I'm protected with ECO and PLC. My puts wash out. What if we go above $5? If we go above $5, then essentially I've got corn sold at $5. Would all of us take corn sold at $5 today? I think we would. And so for net cost of zero, I can do this. Now, the one caveat in doing anything with puts and selling options is that you do have to maintain margin money on the put that you're short and on the, well, no, not on the put that I'm short because I'm covering that with the other put. I do have to maintain margin on the short call option. So if corn goes to $6, I got a dollar a bushel essentially that I've got to send in. But so you would want to have your lender on board with this because, what happens if, but as of today, if your lender's concerned right now, I think most lenders are concerned about the price of corn right now going from 460 to 430 than they are about corn going above $5. Because if corn goes to 430, we've given up 30 cents a bushel. On 250 bushel corn, that's $75 an acre that we lose outright before we start to get to where ECO and PLC start to protect. So bottom line, with margins tight, every dollar matters. If you don't want to hedge corn today at 460, here's something you might consider. So this is how we're trying to tie all of this together, trying to give you guys ideas on ways that you can protect dollars, not only with the government programs, crop insurance, and the markets as well. So with that, what's coming up? Well, we got several things. The markets are closed next Monday for President's Day. Then at the end of next week, the Ag Outlook Forum will convene in Washington, D.C. You can jump online and watch that virtually. When they convene on Thursday morning is when the government will release all of its updated baseline projections for next year. So they'll put out their new acreage numbers, price projections, all of that for the 26-27 year. Maybe it doesn't mean a hill of beans at this point, but at least it tells you what they're thinking for next year. Our sales closing date in our southern states is March 2nd for crop insurance. On the 10th of March, we'll do this all again. We'll have our updated USDA report at 11 a.m. We'll have our aftermath at noon. Our sales closing deadline in most states then will be on March 16th, that following Monday. So the 15th lies on a Sunday. We get till Monday. So we've got a little over a month to make some decisions there. Good Friday is on April 3rd. The markets will be closed, and then we'll have our reports then in April as well. So with that, I thank you for listening to this month's edition of the Aftermath. If you've got questions, feel free to email them to me or send me a text, and we'll try to answer those. Thanks for joining. We hope you have a great month ahead, and we'll talk to you again real soon.